What are some common accounting errors and how to avoid them? Your accounting system is critical to understanding what's going on in your firm. It is also necessary for tax return preparation and other government compliance duties. That's why getting things correctly is critical. Unfortunately, whether you use a cloud-based or desktop accounting system, mistakes are possible. Understanding what may go wrong and how it affects your business is critical. Even more crucial is understanding how to remedy accounting errors and prevent future ones. Accurate accounting coaching is important to your company's success. Without proper accounting, you won't have the information to guide your company towards lucrative expansion. Filling out your annual tax forms correctly can take time and effort. Your firm could be vulnerable to fraud. The easiest method to ensure your accounting is correct is to understand the most common accounting problems and how to avoid them. There are some common errors, as well as the simple actions you can take to avoid them. Not all errors are equal. 1. Improper record keeping. Although digital technologies have almost eliminated the need to sort heaps of paper into folders and file cabinets, record keeping and records management remain important. You must treat your digital records with the same care as you would paper records. Why is this important? In a tax audit, you may be asked to show receipts or other evidence to demonstrate the legitimacy of a business spend. However, the need for effective record keeping extends beyond tax implications. If you decide to sell your firm, the buyer will most likely require an external audit of your company's finances or a formal organization valuation. In all circumstances, receipts and other paperwork will be requested to ensure the correctness of your financial accounts coaching. Proper record keeping also reduces employee fraud. When employees are aware that they must submit receipts for purchases, they are less inclined to use business funds for personal needs. How to avoid: implement a receipt capture, filing, and backup system and enforce proper use. 2. Insufficient checks and balances. In many small businesses, one individual is in charge of all financial concerns. After all, there is only so much work to be done, and it makes no sense to recruit more people solely for the sake of having checks and balances. Unfortunately, insufficient checks and balances can cause major problems for your organization. Why is this important? If someone other than you, the business owner, manages all of your company's financial activities, it is prone to fraud. Even if your employees are like family, or if they are family, no one in the business, other than the owner, should handle business funds without supervision. How to avoid: implement as many checks and balances as feasible in your firm. At the very least, verify that the individual who conducts your business's bookkeeping is not the same person who makes the business's deposits. Avoid granting staff signature authority on your company's bank accounts. Also, make sure to review your company's bank statements, including photos of canceled checks, every month. 3. Changing a closed period. Changes to a closed accounting period can cause your financial statements to be inaccurate, leading you to make business decisions based on incorrect information. If you update the information within the period for which a tax return has been filed, you may be required to file an amended tax return. These blunders in your books are simple to prevent, but can be expensive to correct. Why this matters: an accounting period is regarded as concluded when all of the data for that period has been entered, bank and liability accounts have been reconciled, and the reports have been judged correct. Any modifications to a closed accounting period require that you repeat the closing procedure. Unfortunately, it is quite easy to mistakenly post transactions to a closed accounting period. All it takes is an erroneously entered transaction date. However, there is good news. A simple procedure at the end of your accounting period can prevent this problem. How to avoid: most accounting software allows you to create a closing password for your books at the end of each accounting quarter. However, many business owners and bookkeepers do not use this option. If your accounting software supports a closing password, start using it. If you attempt to post or edit a transaction within a closed period, you should receive a pop-up warning of the change, preventing you from making a mistake. 4. Skipping bank reconciliations. Bank feeds integrated with accounting software have enabled quicker data entry and real-time matching of account balances in your books to those displayed by your bank. However, this does not eliminate the necessity to balance your bank and credit card bills every month. Why is this important? When you reconcile your accounts at the end of the month, you compare the information in your books to an external document, such as a bank or credit card statement. This not only helps you find and correct errors, but it also helps you avoid fraud. How to avoid: make it a habit to reconcile your bank and credit card balances each month. Make a note in your calendar to ensure that this is completed within a few days of receiving your statement. If you use bank feeds, reconciliation should take only a few minutes. What are some common accounting errors